Picture this. One company raises $75 billion in a single day. Its stock jumps 19% before the closing bell even rings. And on that very same day, the asset that claims to be the future of money is sitting at half its old high point, looking like it's losing the race. So which one is actually winning? Stick around, because the answer is not what the headlines are telling you. Here's what we're covering today. First, the actual event that triggered this story and the record it broke. Second, where that mountain of cash came from, because money never appears out of nowhere. Third, why the company at the center of this isn't really in the business people think it's in. Fourth, a bigger pattern that has repeated every single time human civilization has upgraded itself, and what that pattern says about where money is headed next. And finally, we'll land on where a scarce digital asset actually fits into all of this. Let's get into it. In the middle of June 2026, a rocket company went public on the Nasdaq stock exchange. The opening price was $135 a share, and by the end of the first day it had climbed 19%. Total capital raised, $75 billion. To put that in perspective, that shattered the previous record for the biggest initial public offering ever, a record that had stood since the Saudi Arabian oil giant Aramco listed back in 2019. By the time trading closed, this rocket company was valued at $2.1 trillion, instantly making it the 9th largest company on the planet. Meanwhile, on that exact same day, Bitcoin was trading around $62,000, roughly half of where it had peaked back in October 2024. Two headlines side by side, a mountain of fresh capital rushing into a rocket company, and the leading digital asset looking sluggish and half-priced. Most people read that, shrugged, and moved on. But the more interesting story isn't in the headline. It's underneath it. Let's start with a simple question. Where did $75 billion actually come from? Money doesn't get printed out of thin air every time somebody wants to invest. It gets pulled from somewhere else. Think of the entire pool of global investment capital like a fixed amount of water in a series of connected tanks. When one tank fills up fast, it's usually because valves elsewhere just opened and water rushed out of them. In the months surrounding this IPO, Bitcoin-related investment funds saw about $500 million flow out. Money moved out of stock markets too. This is what economists call liquidity rotation, capital constantly searching for wherever the crowd currently believes the biggest opportunity is sitting, and reallocating itself there. And here's the thing about that crowd's attention, it's incredibly fickle. Last September investors were chasing Bitcoin with classic fear of missing out energy. Back in January, the obsession was gold. Now it's shifted again, toward chipmakers, memory manufacturers, and rocket companies. The target keeps changing. What doesn't change is the herd behavior itself. Here's an analogy that might help. Think of financial markets like the surface of the ocean. The waves you see, the day-to-day price swings, are driven by wind, loud and visible and honestly kind of random in the short term. But underneath that noise, there's a slower, more powerful current pulling everything in one direction, driven by tides rather than wind. Watch only the waves and you'll misread where the water is actually going. To understand why $75 billion found its way into one company in a single day, you have to look at the current, not the wave. So what is that current actually pulling toward? Let's talk about what this rocket company really sells. It's tempting to think of it as just an aerospace business. But look closer. Its satellite internet service already reaches over 100 countries, functioning at sea, in conflict zones, in places with no other connectivity option. Its workhorse rocket is reusable, which has driven the cost of reaching orbit down dramatically compared to the old throwaway rocket era. And its next-generation vehicle is being built with an eye toward eventually reaching Mars. Strip away the rocket engines and boosters, and what you're really looking at is a company building the basic infrastructure for wherever human civilization goes next, on this planet and potentially off of it. Global investors didn't hand over $75 billion for a joyride to orbit. They bought a small slice, roughly 3.5% of the company, because they wanted a piece of that infrastructure layer. Now zoom out further. Rank the largest stores of value in the world as of mid-June 2026, and gold sits at the very top, worth close to $29.5 trillion. Below that, a cluster of massive technology companies, chip makers, search and cloud giants, device makers, e-commerce platforms. Our rocket company slots in right around 9th place at that $2.1 trillion valuation. Bitcoin sits further down, around $1.3 trillion. Here's the more useful way to read that list, though. It's not just a scoreboard of company size, it's a map of where human capital is actually flowing. A handful of these giants aren't really product companies anymore. They're becoming the architects of civilization-scale infrastructure, the operating layer everything else runs on top of. Global capital is racing toward them, essentially placing a massive bet on a future built around artificial intelligence, automation, and expansion into space. This brings us to a pattern worth sitting with, because it's happened before every single time. Go back far enough and human civilization ran on agriculture. Value was stored in whatever the land produced, and trust was built around what a local community agreed to accept as valuable, whether that was grain, shells, or livestock. Then trade routes expanded across oceans and continents, and civilization shifted into a commercial era. Suddenly you needed something universally recognized and portable, so gold and silver became the store of value that let merchants trust each other across huge distances. Then came industrial civilization, factories, global shipping, mass production, and money had to scale with it. That's when a centrally issued currency, backed by gold reserves, became the operating system running underneath world trade. Notice the pattern. Every time the underlying infrastructure of civilization took a leap forward, the money system running on top of it had to leap forward too. It never stayed the same. Not once. So here's the question worth asking. The infrastructure being built right now by these dominant companies is entirely digital. Artificial intelligence computing happening in massive data centers. Cloud storage holding the world's information. Satellite networks moving data at the speed of light. If the infrastructure of this next era of civilization is digital by nature, doesn't it stand to reason that the money moving through it will eventually need to be digital native too? That's not a wild prediction. That's just following the same pattern that's played out every single time before. Consider what's already forming on the horizon. An economy where machines transact directly with other machines, no human clicking confirm purchase in the loop. Artificial intelligence systems buying their own computing power. Self-driving cars paying for their own parking. Satellites settling data transfer costs with other satellites, automatically, constantly, potentially millions of times per second. Now ask yourself, could the traditional banking system handle that? A wire transfer that takes a business day to clear, a human-run bank sitting in the middle of every transaction, permission required, fees attached. That system was built for humans moving money occasionally, not for machines moving fractions of a cent to each other non-stop, around the clock. Just like print newspapers eventually gave way to internet-native media because the internet fit how information actually needed to move, the same kind of shift may be coming for money, from something built for a slower, permissioned era towards something native to how digital systems operate. And there's a slow-motion story happening with the dollar itself worth mentioning here. Since the US broke the direct link between the dollar and gold back in 1971, the dollar has lost roughly 7% of its purchasing power annually, according to widely cited inflation data. That's not a dramatic headline most years. It's a slow erosion, the kind you don't notice day to day but absolutely notice over a decade. Speaking of gold, let's give it its due, because it's still the single largest store of value humanity has, at that $29 trillion figure, roughly 6 times the size of the world's biggest chipmaker. For about 5,000 years, gold won by default because nothing else combined scarcity, durability, divisibility, and portability as well as it did. Nothing could beat it, so everyone used it. Bitcoin is frequently called digital gold, and the comparison holds up, then goes further. Its total supply is hard-capped at 21 million units, scarcer than gold's naturally occurring scarcity. It divides into far smaller increments than a physical bar of metal, and moves anywhere on Earth at internet speed, none of which gold can do. And if you hold your own private keys, no government or institution can simply seize it the way physical assets can sometimes be confiscated. It's worth noting that lawmakers in the United States have been actively working on legislation, informally discussed under names like the Bitcoin Act and later reworked into what's referred to as the ARMA Act, aimed at potentially treating Bitcoin as a strategic reserve asset alongside gold. That's not a random coincidence. It reflects a growing view among some policymakers that Bitcoin may be the strongest challenger gold has faced in its 5,000-year run. As of that same week in June 2026, Bitcoin's total market value stood around $1.28 trillion. If it were to triple from there, it would surpass silver's entire market value. If it matched gold's market value, a single Bitcoin would be worth more than $1.5 million. Nobody can tell you if or when that happens, and we're not here to promise you it will. But it's worth understanding the scale of what people are debating when they talk about Bitcoin's long-term potential. Here's one more way to think about how change like this actually unfolds, using something you learned in a science class at some point. If you heat water gradually from 30 degrees Celsius to 35 degrees, nothing dramatic happens. It's just warmer water. But keep adding energy, and at exactly 100 degrees, everything changes at once. It boils. Not at 99. The change looks sudden from the outside, but the energy had been building the entire time, invisibly. Bitcoin's price history arguably follows something similar. Since it was created in 2009, it has moved through repeated cycles, each one eventually setting a higher high and a higher low than the one before it. A pullback that looks dramatic when you zoom into just the last year or two tends to look like a familiar, repeating pattern once you zoom out across its full history. And underneath the surface, the temperature does appear to be rising. Major financial institutions, including some of the largest asset managers and investment banks in the world, have been building Bitcoin-related products. Multiple pieces of legislation are moving through the U.S. Congress addressing digital assets and stablecoins. Sovereign wealth funds from various countries have reportedly begun taking positions. None of that guarantees a particular outcome, but it does suggest institutional plumbing is being built quietly while public attention is elsewhere. Here's a detail connecting our two storylines directly. The person most closely associated with that record-breaking rocket company also holds a significant amount of Bitcoin, reportedly around 30,000 units combined across his companies, based on public disclosures. Whether or not that's a deliberate signal, it's striking that someone building humanity's next physical infrastructure is also personally exposed to the asset many believe could become its financial infrastructure. So let's bring this all the way back to where we started. A rocket company's infrastructure-scale technology and Bitcoin's protocol-level design might look like they're competing for the same pool of investor attention in the short term, and in a sense they are. But zoom out, and they may actually be two expressions of the exact same underlying shift, civilization building itself a faster, more digital, more automated backbone, and needing a monetary system that can actually keep pace with it. None of this is a promise about what happens to any price tomorrow, next month, or next year. Markets are unpredictable in the short run, and anyone who tells you otherwise is selling something. But understanding the deep current, rather than just the surface waves, might be the more useful habit to build. If this kind of big picture thinking is useful to you, subscribe for more, and let us know in the comments what pattern you'd want us to dig into next. This video is for informational purposes only and is not investment advice. All investment decisions and their consequences are your own.